Everyone, thank you so much for joining us this evening. I'm excited to be here, and I always love when I get to sit back, learn, and bring really valuable information to our community. So today I have Scott Mara. Forgive me if I pronounced it wrong, but Scott is the Vice President of Sales for Advanta, who's a nationwide self-directed IRA firm, and who's who we use for all our multifamily investment deals. And so I've been talking to Scott, and a lot of you who have invested with us know Scott, but I thought it would be great for him to just come on board and really teach us exactly how to use our 401k, our retirement accounts, what opportunities there are in the alternative investing space, especially with the new executive order that is kind of on the docket. So with that, I want to say welcome, Scott. Thank you so much for joining us today. And everyone, please feel free to toss in questions in the chat. We'll wait for him to finish, and then we'll jump into question and answer. So if you have any questions or burning, thoughts about kind of how to move forward, especially after he gives his presentation, please feel free to chime in. And I might have a question or two that I've been waiting for today. So welcome again, Scott.
Great, Nakem, thank you very much for having me on. I appreciate you having me on tonight. I appreciate everybody for taking some time out of their busy day to learn a little bit about using 401ks and IRA accounts to invest into, what Nakem some of their alternative assets. So I make sure you seeing my PowerPoint slides. Make sure you can see those as we go through it.
I will tell you when.
So put in share. Can you see them?
No, not yet. So if you put on the top, there's a screen share button, like two screens.
Mm-hmm.
Click on that. It worked earlier. Yep. Okay.
Oh, there it is. Okay.
Okay. Let's see, give it a second. It's still coming on. Okay, there we go. We see it.
Okay, perfect. Yeah. So again, thank everybody Nakem, thank you very much for having me on, and for everybody for taking some time tonight to talk about how to use IRAs, 401ks to invest in a lot of different alternative assets. As Nakem mentioned a moment ago, it's been in the news quite a bit over the last several weeks due to an executive order from President Trump, which we're going to talk about for a few minutes, and kind of what that means, what it may not mean, and kind of what will remain to be seen when it comes to that executive order. But just a little bit of background on myself. Like Nakem said, I'm the Vice President of Sales here for Advanta IRA. My educational background, I am a licensed attorney in the state of Florida. I do not do any legal work or give any legal advice for any Advanta IRA clients. But I have been with the company for getting close to 20 years now, and knew very little about what it is we're going to talk about today. I knew hardly anything when I started, and have learned many things over the years, seen a lot of different types of investments that people have made inside their IRAs, inside their 401k plans. And my contact information is here on the slide. Nakem has it as well, if you'd like to get in touch with me after the webinar today. Just a quick note about our company. We've been around for over 20 years. We have over $3.5 billion in assets under management. We try to give a real personal customer service touch for all of our clients with account managers that you get assigned to when you open up a new account, and you get one person dedicated to help you with anything you need regarding your account. So it's something we try to set ourselves apart in the industry a little bit. But the only thing that we do at Advanta IRA is administer what we call self-directed retirement accounts. We don't give any investment advice. We don't give any tax advice. We don't give any legal advice. We encourage you to talk with your attorneys, tax advisors, professionals, etc. But really, before doing any type of investment, our job at Advanta is to help facilitate the investments that you choose. And it is up to you to make sure that you're comfortable with those investments and making those investment decisions. We certainly have CPAs and attorneys whose names we can share with you if you need that type of advice. So very quickly, I mentioned, Advanta IRA, we are a self-directed IRA administrator. And so a lot of people say, what is a self-directed IRA? I've heard of traditional IRAs, I've heard of Roth IRAs, rollover IRAs, et cetera. Well, a self-directed IRA is an account where you have control over what it is that you want to invest in. Self-directed, it's not a type of IRA that the IRS recognizes. They still have, the accounts we have are still traditionals or Roths or SEP IRAs for tax purposes. The huge difference is since that we are not a broker dealer and we don't sell any assets, you choose what it is that you want to invest in as long as it falls within IRS guidelines. So you're getting much more control in deciding not just the kind of different investments you want to make, but the types of investments as well. There are custodians that will say they have a self-directed IRA, but you are looking at that point at investing in some type of mutual fund or stock, and you're getting to pick on their platform from assets that are primarily publicly traded securities. But the IRS regulations allow you to invest in a lot of different types of things. You just have to have a custodian who is willing to hold that type of asset. Since we are not broker dealers, the assets that we hold for our clients are typically outside of the stock market. So people are choosing to diversify their retirement portfolio with things that are not tied to that public market. The ups and downs of the markets, the lack of control that people feel when they're investing in the stock market, that's what a self-directed IRA helps to ameliorate, is really allowing you more freedom and flexibility to invest into things that and that you can control. The strategy, people, again, the common question I have in my almost 20 years is kind of why haven't I heard about this before? Why has nobody ever told me about it? I always kind of put it as they don't want you to know. And they are your brokerage firms, your advisors, your banks, whose business models are to have you invest into mutual funds or stocks or assets that they're more comfortable that they will hold on their platform. It doesn't make sense for a Fidelity or a Schwab who is unwilling to hold real estate or real estate type assets on their platform. They're not going to tell their clients that you can invest in real estate, you can invest in precious metals, and you can invest in crypto and the different things you can do with a self-directed IRA. Because if Fidelity were to send out an email tomorrow, telling people all the different things you could do with your IRA, a lot of people would ask them for assistance. And since they don't do it, people would obviously take their money and go elsewhere. So they don't really want you to know this is possible to invest in these types of alternative assets because they would lose business. But due to their whatever efforts they had, there was a recent executive order that Nikem mentioned a moment ago the executive order was titled Democratizing Access to Alternative Assets for 401k Investors. And so a lot more people now are waking up or hearing about the fact that you can invest in things outside of mutual funds or stocks inside of a retirement portfolio. Now, this executive order, one thing to note, it is not binding law. It is merely the president, in a sense, almost making somewhat of a political statement saying, hey, we want to make private investments more available to the general public. And so that executive order back on August 7th directed the Department of Labor and the SEC to start removing regulatory barriers that allow the plans more access to these types of alternative assets. Some of the regulatory barriers that exist, and one of the biggest ones, and I'll give my thoughts on this more in just a moment, is that for any 401k plan, regardless of the size, whether it's a 10-person business or a 10,000-person business, there is a trustee of the 401k plan who has a fiduciary duty to make investment options available within the plan that really serve the best interests of all of the plan participants. They actually have a duty to all the participants to make sure that the assets that they can choose from in the plan are, I guess, quote, good investments, right? Something that people would be able to either understand, hopefully gain money from. They're not putting anything deemed to be too risky that the average person may not understand. So that's generally how 401ks are set up. You have trustees who have those types of fiduciary rules, but the executive order mentioned specifically allowing people, or hopefully allow people, to invest into real estate, private equity, crypto, and the genesis of this is to give everyday investors the access to the same types of investments that typically over the years have only been permitted either by institutional funds or high net worth individuals. So the executive order really would like to make those types of assets, the things that we're going to talk about tonight, available to everyday investors. Now, the issue, though, that I see when I look at the executive order is that the likely end result, and if it's even written in part of the executive order, is that a lot of 401k plans will end up having a different or new type of fund that you can choose from within your plan, where the assets in that particular fund are allocated to different private equity or real estate or investments inside the fund. But I don't know that you're going to be able to take your 401k with your current employer and be able to invest with specific operators or into specific projects. For instance, you may be able to invest in an asset allocation fund tied to private equity, but you're not necessarily going to be able to choose a specific private equity investment like a startup company or a real estate syndication. We will see how things go, but that's my take and my guess because of the issues with the trustees. The trustees do not want to necessarily permit everyone in a 401k to be able to truly self-direct their account and go out and choose whatever they want to invest in, because that trustee may have a fiduciary liability to either check out and kind of give the okay or approval to each investment. So I think even though this executive order purports to make 401ks more available or allow you to use your 401k for these types of assets, it might not end up being kind of what we hope it is. Now, obviously, things can change. They can write the rules different. Maybe they will start absolving the trustees of some of their fiduciary duties as well with the 401k to make these types of assets possible. The good side, at least for our business, I think for the people in general, though, is you are learning that you have the ability to invest in alternative assets inside of an IRA or inside of a 401k plan. I think that's one thing that's getting missed as we talk about the executive order, or that people think that this is something where the law has changed. And all of a sudden now people can, this is something you weren't allowed to do before. And the reality is you've always been able to use your IRA. 401ks have been able to invest in alternative assets. It's that 401k plan trustees over the years typically have not allowed for these types of assets due to the fiduciary obligations that they have to the plan itself. So a little bit of background on the executive order, put a little more color to what came out. And as you're reading things, definitely going to be some developments as time goes on. I think the Department of Labor already rescinded a prior guidance during the last administration where they had actually dissuaded people from investing in private equity and have reversed course on that side of things. But there are going to definitely be either more regulations, more changes that come out as we finish out this year and into 2026 and really see what takes place, where this executive order or ends out. So happy to address questions on that. Again, if you have those, as Nakem said, throw them into the chat. We'll make sure we get to them as well. I think why people choose to self-direct is always an important thing to understand. I'm assuming a lot of you on the call have either self-directed before, or maybe are considering it, or maybe after hearing tonight would be a little interested in find out more. And I think it's, again, the reason why people are doing it are a few. For some, this is kind of new money for them, right? You're looking to invest, maybe you've invested into a multifamily syndication personally on an individual basis, and there's another opportunity that's come up. You'd like to take advantage of it, but maybe you don't have the personal cash that you'd like to part with for the investment. And when you realize you can use your IRA, you can use your old 401k funds, you're able to actually use that money so that you don't miss out on the next upcoming deal. So it's kind of existing investors just realizing they have another bag of money that they can use to make that type of an investment. For a lot of people, though, there is the stock market fatigue, the ups and the downs, the impacts of events, half a world away that cause the stock market to drop or the stock market to dip, and you have very little control over those various geopolitical events. But you may be able to control investing with a friend or someone that you trust and understand, and investing in real estate in your local community, or with an operator who you've known for a long time. So people choose to at least diversify a portion of their portfolios due to that fatigue. And for others, depending on the assets that you're investing in, if you're anticipating some large gains, you may be in a higher tax bracket personally right now, and you don't really want to invest personally because of the fact that those gains are going to maybe even push you higher. You'll be paying a higher tax rate. The ability to invest inside your IRA or inside your 401k means that the income that's being generated is coming back to the IRA account. It is not impacting your personal tax situation. So the income, the gains to your IRA do not get reflected on your individual 1040. So the different investment structures, and this is by no means an exhaustive list. These are just some of the different things that we've seen people invest in when it comes to real estate specifically, a couple of other alternative assets as well. But I think it's a thing I always find funny when I talk to new clients, new prospects, or meet people, and they say that they invest in real estate. Is I always tell them they need to be a little bit more specific, because real estate can take on so many different forms and so many different avenues, and you can sit in so many different chairs, wear so many different hats when it comes to investing in real estate. I mean, in real estate, you could be in a multifamily syndicator or being a limited partner in one of those deals. You could invest in commercial property. There's residential real estate that you could invest in either as a flip or just as a buy and hold, rental property, or even Airbnb. We've seen people lend money from their IRAs, have their IRAs act as a bank, where their IRA is issuing a mortgage or a deed of trust, or even an unsecured line of credit. And again, again, when it comes down to self-directed IRA accounts, you're making the decision as to the appropriateness, your risk tolerance with these different types of investments. People have invested into joint ventures. They've invested into private businesses, startup. We're actually dealing with a couple different banks right now that are local community banks that are forming, and they're raising capital that they can use for their operations. And people are investing their IRA to buy stock in the local community bank. And if that community bank gets bought out one day by a larger bank, their IRAs will stand to benefit from the sale of the stock. So again, there's a lot of different things you can do within your IRA account. We'll talk a little bit about the things that you can't do within your IRA. There's only a few different investments that you can't make, but really anything real estate related is an allowable asset within a retirement account. Again, going back to some of the motivating factors, I think why are IRAs a good capital source? I think if you're investing through your IRA, you can invest over and over again through the account without any tax repercussions to you. You're building wealth through the different investments you're making. Outside of an IRA, if you're investing and you want to continue investing, you need to do a 1031 exchange each time. I'm not sure how many people are familiar with 1031s on the call, but it's a tax deferral strategy that requires you to get an intermediary. You have to identify replacement properties, so definite rules that you need to follow. But IRA accounts are tax deferred entities within themselves, and you can just invest and reinvest as often as you'd like. Hopefully you're getting better returns for the investments that you're seeking in real estate or private equity. If you're investing through your IRA account into real estate, there's also no outside approval needed. It's your decision to make that investment. It's not going to a bank, not going to an advisor to get permission or have someone evaluate your finances to make that investment. You have that cash in your IRA. You can simply make the investment by just signing the right paperwork. But I think one of the biggest reasons that people use their IRA accounts or use their old 401ks to invest in real estate and other types of alternatives is that most people don't plan on touching their IRA or their old 401k plan for a number of years. They may still have 10, 15, 20 plus years to retirement. And that bucket of money is for them when they're 65, 70 years old. They may have a personal savings account that is kind of an emergency fund, right? Loss of job, medical emergencies, things like that, that you have a rainy day fund that you want to keep in more of a cash position because you never know when that emergency is going to come up. But your IRAs and your 401ks, which is money that's not being touched for the next 10 or 15 or 20 years, you don't mind putting that to a 3, 5, 7-year investment because you weren't planning on touching that money anyhow. And again, I think that's a big reason why people have used their IRA accounts over the years more and more, is to allow them to preserve their personal capital for other needs that they have. So the account types, this is an important slide to understand, okay, what monies that I might have could I actually use for self-directing? What kind of bags of money do I have access to? There's really kind of two main categories are really IRAs and small business plans. So if you're thinking about self-directing, or this sounds kind of interesting, if you have an account that is designated as an IRA, whether it's traditional, it's a Roth IRA, it's a SEP IRA, a simple, or maybe you've inherited an IRA from a loved one or a deceased individual, all of those accounts can be self-directed. Again, it's just a matter of you filling out the right paperwork to get some of the money moved over into a self-directed account to allow you the flexibility to then make those alternative assets. If you are a sole proprietor, or you own your own business and you have your own solo 401k plan, maybe you have a cash balance plan, or maybe you have a pension fund for your business that you've started, you can self-direct those accounts as well. Because you're the owner of the business, you can make those decisions to make that plan allowable to hold truly alternative assets within the particular plan. So again, as you would be the trustee of your own 401k or of your cash balance plan, you can certainly make the changes or do what you need to do to access those funds. The other big bucket of funds that people have that they could use are former employer plans. So you worked for an employer for a number of years, you put money away dutifully over the years, the money has grown, but you've now left that employer. Once you leave the employer, you can roll over any amounts of those monies from those plans into a self-directed IRA. And the common employer plans that we see that get rolled over are either 401ks, which are for private companies. There are 403b plans for individuals who work in education, whether it's the local school teacher, universities. A 403b is essentially a 401k for those types of employees. There's 457 plans for local, state, and city government workers. And there's thrift savings plans, TSPs, for federal employees like the military and the postal workers. So any former employer plans can certainly be used for rolling over inside the IRA. And Kim, can you still hear me okay? Okay, good. I'm just getting a notice that my internet connection's a little unstable, but it looks like I'm good. So, so any type of IRA, any type of former employer's plan, the only restriction to self-directing your account is with current employer plans. If you have a current 401k through a company or through a business or through a university, they can restrict you to move those funds as long as you're still employed there. So whether it's again, your 403b through the university, as long as you're under 59 and a half, they can restrict your ability to move the funds out of the particular account. So that's the only restriction, but any former employers, any IRA is certainly eligible to be used. So you have money in an IRA, and you're asking, how do I get that to a self-directed IRA without paying taxes? Very simple. It's by doing a transfer, which is a movement from one account to another. It goes directly from one trustee to the other without touching your hands. It's a tax-free, non-reportable movement of funds. You can do as much or as little of these funds from one IRA to the other, and you can do them as many times as you'd like. So if you had, say, $500,000 in a Schwab IRA account, and you'd like to use $100,000 to invest in an upcoming real estate deal, you can transfer just the $100,000 you need to make that particular investment. And again, that is by doing a transfer from one IRA custodian to the other. You can move money back and forth between custodians whenever you'd like. The other way of moving funds is a direct rollover. So if you do have money in a former employer's plan, you request that employer roll over funds to your new self-directed IRA account. Again, the funds are going directly from your old employer's plan to the IRA account. Doesn't touch your hands. It's a non-taxable movement of money. Again, directly rolling over from your old 401k or old employer's plan into an IRA account. Another thing I always like to say about transfers and rollovers is there are a lot of advisors out there who don't understand what it is that you may be doing. So if you go to your advisor and say, hey, I'd like to put some money into an alternative investment or to a real estate deal that I found, and I want to use my IRA to do it, they may start warning you about taxes, and they start warning you about penalties for taking the money out of the IRA as an early distribution. And it's because they don't understand what it is that you're actually looking to do. You're not looking to pull, when you use a self-directed IRA, you're not pulling money out of the account personally and putting it in your own bank account. You're moving it from one IRA account where you're limited to maybe securities investments, and moving it to another type of IRA where you have more flexibility with what it is that you invest in. So that's a very important thing, is you're not actually pulling the money out of the account. You're just moving it into another account that gives you greater freedom, greater flexibility to do what it is that you want to do. So again, that's something that a lot of advisors who are just not familiar with self-directed IRAs and don't understand. And so when they tell you have taxes or penalties, they're not kind of getting the full picture. So we had a slide up with the investment structures. I mentioned there's only a couple things with an IRA account you can't do. The only two prohibited investments that you cannot make with retirement funds are you cannot invest in life insurance and you cannot invest in things that are deemed to be a collectible, like antiques, artwork, stamps, coins, things like that. Those are the only two prohibited investments in the IRS code. So the rules were written back in 1975 and said these are the things that you cannot do. Cannot buy life insurance, cannot buy collectibles. There is no master list where you can see that you can invest in real estate or crypto or stocks or mutual funds. It simply says no life insurance and no collectibles as the prohibited investments. The other restriction the IRS puts in place are dealings with certain disqualified persons, and this involves what the IRS calls a prohibited transaction, which means you may be buying something that's allowable, like a piece of real estate, but your IRA is transacting or dealing with someone who's considered to be a disqualified person. So it's an issue where the IRA is buying or selling an asset between the IRA as its own entity and someone who's considered to be a disqualified person, or situations in which a disqualified person is getting a benefit from the assets in the plan. So one of the quick questions that we always get is, who is disqualified? So the disqualified persons for your IRA include yourself and your spouse, your parents and grandparents, your kids and grandkids, and any entity or business that is controlled or owned by one of those individuals. Those are all the people who are considered to be disqualified. So if my IRA was looking to buy a piece of real estate, I can't use my IRA to buy property that I already personally own, or maybe if it's a property I own through my LLC, that would be prohibited as well. My IRA cannot lend money to any of these individuals. None of these individuals can lend money to my IRA account. Brothers and sisters, aunts, uncles, cousins, friends, relatives, colleagues are not disqualified persons. So outside of just directly up and down your lineal tree, you can make different investments with those different individuals, brothers and sisters, aunts, uncles, and cousins. Again, as long as it's on a fair market value basis. The IRS always and does expect that your investments that your IRA makes are for investment purposes. You can't lend your money to your sister at 0% interest. That doesn't make investment sense. But you can certainly lend money to your sister at 6 or 7% interest and have her pay your IRA back just as she would pay a bank back. So again, no life insurance and collectibles, and no transactions between the IRA and one of the individuals is considered to be a disqualified person. I think for those of you on the call, I think it's always a good exercise for people to do if they're either already investing or especially if they're looking to get into investing, is to kind of talk and think about what type of an investor you see yourself as. Are you somebody who's more active, where you're looking at rental properties, you're looking at rehab projects, you're looking to do wholesaling, where you're in control, you're making the decisions, you're more hands-on, but you're also giving up more of your time and energy, and ultimately you are responsible for the details of an investment. Versus, on the flip side, people who cater to or tend to go more towards passive investments like private placements, syndications, doing private lending from your IRA, where there is not as much of a time commitment. You look at a deal up front, you evaluate it, you decide to move forward, you put your money into the deal, and you sit back and let somebody else do the work. And you're not bothered by all those minutia. You get your mailbox money every month or every quarter going right back into your pocket or maybe into your IRA's pocket. But downside of being a passive investor, a lot of times you're turning over your capital. You then have little or no control over the actual investment itself or the decisions made by the manager. So again, I think this is a helpful slide if you're kind of considering getting investing, is which of these avenues attracts you more. We certainly have clients. I've certainly seen many investors who do rental properties but also do private lending and kind of do both. But I think it's a good exercise to have and go through, and you're kind of figuring, if you're, especially again if you're looking to get started with investing in general. So I have a couple case studies. Just wanted to illustrate a little bit about the process and what's involved and kind of how it works. The first case study is funding a rehab project. So it's an IRA acting in the position of a private lender to do a private loan from the account. In the case study, we have Bill and Stephanie. Bill bought a house to flip, needs more money to actually complete the flip, complete the property, get it sold, get it properly rehabbed, make some money. He's known Stephanie for years. He says, "Hey, Stephanie, here's my new project. I'm looking for some investors." She says, "Hey, I have an old 401k plan. I'd love to be part of your deal. Can I use my old 401k?" And Bill says, "Absolutely. You can partner with Advanta IRA, get an account set up, and do the loan." It's important, and this goes for the next case study and all case studies I would ever do. It's Stephanie's IRA account. She needs to make sure that she does her due diligence on the property in this case, right? But she's lending money and it's going to be secured by a piece of real estate, so she wants to know exactly what property she's lending on. But also doing her due diligence on Bill. She's lending money to Bill. The property might look great, it might be looks like a good deal, but she also needs to make sure she knows who she's dealing with on the operations side. So she decides, "Hey, Bill, I'll lend you $50,000. You can finish the rehab, and let's work out the loan terms." And I think that's always one of the attractive things I think is neat to me about private lending is as if it's your IRA account, you are sitting in the same seat as the banker and deciding kind of what those loan terms, what's that going to look like for making the investment for your IRA. If you're going to lend Bill $50,000, what type of interest rate do you want? Do you want him to have to share part of the profits? What kind of collateral do you want him to put up for the particular deal? So with any investment you make through a self-directed IRA, and this is something that Advanta, we make sure happens every time, is that any investment paperwork, in this case, we have a note, probably a mortgage or a deed of trust, needs to reflect that the investor is the IRA account itself. It's not Stephanie as an individual. It is her IRA account as its own legal entity making the investment. So the investment paperwork would show the lender as Advanta IRA for benefit of Stephanie's IRA and her account number. We will review the paperwork to make sure that that wording for her IRA is present on all the documents. And we will then send everything to Stephanie for her to review and approve. So we're not necessarily looking at the terms that they agreed on and making and passing judgment there. We are only looking to make sure that her IRA account is listed as the actual lender. So if the IRS ever looks back at her IRA account and wonders, "Hey, she sent $50,000 out of her account. She got so much money back into the account. How do we know this was legit?" We can simply point right back to the paperwork that shows from the start this was an investment inside of her IRA account. It was not something she pulled money out personally and should have paid taxes on. And it's her IRA investing all along. As far as the terms, this particular client we had did a very low interest rate for her loan, but she did ask for 25% of the profits. She and the borrower negotiated kind of how profits would be calculated, and she did get the property secured by a mortgage on the particular property. Bill had his attorney prepare the note and mortgage, and again, we made sure that Stephanie reviewed and approved all the paperwork before we sent any money out of the account. So she would have set up her IRA account with us, filling out our paperwork to get her information, name her beneficiaries. That's step one. She reaches out to her 401k company to have the funds rolled over to Advanta. We get the cash in, and then she tells us, "Hey, I'd like to lend this money to Bill." And we will then look over all the investment paperwork, again, to make sure it's properly titled and make sure she's approved of it as well. Once that's complete, Bill's selling the property. He's going to get a $40,000 profit after all his closing costs. So at the end of the day, Stephanie's IRA gets back her principal. She had some monthly payments, and she got a percentage of profits all coming back into her IRA account rather than to her personally. So she grew her IRA by a little over $11,000 during the term of that particular loan. Bill still made out with a nice little profit from borrowing funds from her IRA and then paying it back. All right, so that's a case study again when an IRA is investing passively into a private loan, kind of just a one-off deal. Stephanie was lending money to one individual based on one particular property. Nobody else was involved. Our other next case study we're going to go through, though, is investing as a limited partner, still a passive investment, investing into multifamily syndications and into a kind of a real estate project. In this particular case study, we have Jane and John. John has money in a Roth IRA account over at Vanguard, looking to do something different with his funds. He meets Jane. Jane has an offering. They're going to be buying and remodeling an apartment complex. The property's undervalued right now. They can get a good deal on it. They can make some fix-ups to it, get the rents, raise the rents, and still keep them in line with current market trends. There's a lot of opportunity for some growth and some value for making that type of an investment. Jane, in this case, will provide John with the subscription documents, the prospectus. So she says, here's my project, here's where the property is located, here's my business plan, here's the numbers that reflect kind of what we think we'll be able to do with rents, here's the types of returns that you could expect. So that's, again, up to John to review that paperwork and say, yes, I would like to move forward on this particular investment. And so John looks over the prospectus, decides, I'd like to use part of my IRA account or part of my Roth IRA to make this particular investment. So again, same steps. He fills out paperwork to open up an account, transfer money, again, tax-free from Vanguard, from his Vanguard Roth to his Advanta Roth, names his beneficiaries. Our job at Advanta IRA, again, set up the account, request a transfer from Vanguard, and then let John know when those funds arrived. And then more so, again, on the investment process, we'll want to make sure that John's IRA gets listed as the potential investor in this deal. So the subscriber's name on the documents will be Advanta IRA for benefit of John Smith. The tax ID number that gets used is our trust tax ID, not John's social. All of the tax reporting will go back to the IRA account. Ultimately, after John's approved the subscription documents, we sign them. We send a wire out of his account to fund it. So John's account had $100,000 in cash. We send that out. It's replaced by $100,000 interest in Jane's syndication. Going forward, any future dividends, profits, etc., goes back into John's IRA account. All property sells down the line, all of those proceeds, again, from being an LP, from being a limited partner, will go back to John's Roth IRA account. So again, the process, regardless of the investment you're making, the two examples I used tonight were a private loan, was doing a multifamily syndication. The steps are always the same. It's completing paperwork to get the account opened. Step one, we can do that via DocuSign to get that taken care of very easy. Then funding the account either via transfer or from a current IRA, doing a direct rollover from an old 401k. Again, number two is important. It is not taxable to move money from an old 401k or to move money from another IRA into a self-directed account. Okay, it's a non-taxable movement of money. We help give you directions on exactly what needs to happen, whether you need to request the rollover, whether we will process the transfer for you. And then step three is making the investment. Again, we're going to work with the sponsor to make sure the paperwork gets properly titled, make sure the account owner reviews and approves all of the investment paperwork before we release any funds at all. Now, a lot of clients that we talk to are already on step three. They've decided on the investment, and we're helping them go backwards kind of and get the account open and get it funded. The total process can usually take between 1 and 3 weeks, depending largely on the original source of funds. Rollovers from 401ks typically take 2 to 3 weeks, depending on who your administrator is. Transfers from other IRA accounts a lot of times can be done in a matter of a week or so if your other custodian will wire funds to us. So we kind of go over that with you all up front to kind of figure out where your funds are at, let you know what the steps are going to be taken, and give you hopefully a better idea on the timing that's involved. So Nikem, that's kind of all my prepared remarks. I want to definitely leave enough time for some questions. I'm sure we're going to have some, and I know you had some things you wanted to share, but yeah, happy to kind of cover what anyone might have what any questions that we had.
Perfect. Thank you so much. Before we jump into questions, I just wanted to kind of reiterate the reason why I brought Scott on today. And Scott, I wanted tell you thank you so much for such a wonderful presentation that you did. But the truth is, what we don't know, a lot of us on this call have the resources, right, to invest in alternative assets. But sometimes we don't have the access because we just don't know. So from, ever since we started Phoenix and, acquiring multifamily investment deals, right, we've had the opportunity to educate our investors on using their retirement account, whether it be an old 401k or any sort of IRA. And Scott did a wonderful job of listing it. But we don't know is that as of March of 2025, I think there was about 40 something trillion dollars in retirement accounts. Now, some of that is new active retirement accounts, but some of that is also old accessible retirement accounts. And in terms of like old 401ks and active, IRAs and all the gamut that Scott talked about. But the whole premise and the whole purpose of this is to just know that these opportunities are available for us to use it, to still think about how we can grow wealth, right? How we can diversify and not just keep it in the stock market, not just keep it in that 401k doing nothing. A lot of us here have switched jobs multiple times, and I've had conversations with a large number of investors who I keep hearing, man, I didn't know that this opportunity was available to me. Tell me more. And always, to be able to have Scott as our custodian, as our liaison, to help kind of make the process as seamless as possible has been very helpful. But I want you, my heart behind bringing Scott today and having this conversation is that that now that you have access, right? You've heard the conversations and you now understand how this works and know that these opportunities are out there, whether it be you're investing with Phoenix, whether it's, whether it's the deals that we have or even other opportunities that are in front of you. Like if you want to do your own as an active investor, these are all opportunities that are available for you. So my heart is that we take advantage of this, right? And with the new executive order, don't you worry, I will make sure that as I learn, as I get informed, that you will also know about it so that we know what we can do with our active 401k. I agree with what Scott said. I think that it's not going to be as easy as we think that we can do anything with it. I think it's still going to be structured, but at least we still have the opportunity. At least these conversations are happening and we have like I said, the opportunity to be able to make that investment. And the whole idea is diversification. The whole idea we talk about at Phoenix is how can we grow wealth and how can we do it together? How can we think about alternative assets that are now available to us because now we know about it and now we're educated? So I just want to say thank you so much. As the questions are coming in, thank you so much for your time. And Scott will put his information on as well. And I will also put a Calendly link. If you want to sit down and have that conversation with me or with Scott, if you want to jump on, and have the conversation and say, hey, this is what I have in my 401k. This is our old 401k. This is an IRA that I have. What opportunities are available to me? I'll let you know what acquisitions we have, what active deals we have at Phoenix Capital, but I'll also be able to put you in touch with Scott, or his information is on, and you have access again to be able to use that to do with it anything that you want. So again, Scott, thank you so much for the opportunity to speak tonight. I'm going to pull up the questions so that you can see it and then so that everyone else can see it.
Yeah, and as Nkem said, I think he just said there was I think it was the end of December, there was $44 trillion in retirement accounts. That's more than, at least at this time, what the national debt is. And I think of that, there's about 30 something trillion that you can access. So yeah, that's kind of the IRAs and 401ks.
Absolutely. Scott, Grace asked, can you invest in a project that you're managing yourself?
Great question, Grace. That's kind of going back to the slide about the self-dealing rules. It's kind of, I think if we take the two different scenarios, I think one is more okay than the other. If you're looking to use your IRA kind of actively to go buy a rental property, so your IRA, buys a rental property, the income comes in to the IRA, and you're taking care of, hiring your contractors, talking with your tenants, and all the money's going in and out of the IRA. I think you can kind of manage that, quote unquote, to yourself. You're kind of overseeing it because you're not being compensated. It's just you're kind of managing your investment. On the flip side, I think if you're doing a capital raise where you are syndicating an apartment complex and you are one of the GPs, the general partners who is getting paid for your role, we have discouraged people from making that type of investment from your IRA because you are being paid to actively manage that project. So the IRS could argue in a roundabout way that your IRA is paying you for that. So it's kind of a little bit different, maybe depending on the type of an investment. You certainly have say-so in your investments, but you're not supposed to be compensated in any capacity. So I hope that answered that question.
Thank you so much for that. The next question is from Abiodun, and he said, what are the charges involved in doing a self-directed IRA transaction? Great question.
Yeah, great. Yeah, so our fees, so we are not, a lot of people are familiar with like commission-based structures where you're charging, brokerage commissions and percentages of assets. We simply charge flat administrative fees. It's a $50 one-time fee to open the account. It's a one-time $95 fee to make sure all the paperwork gets done properly. And we charge a flat $295 a year to hold an investment in the account, regardless of the value. And for that $295, we receive and deposit all of the income. We pay any expenses. We do all the IRS reporting. And I think for Phoenix investors, we do waive the $50 application fee. So those are our charges. Again, it doesn't matter initially how much you're investing. It's simply our work as an administrator and a custodian.
Perfect. Next question. Do you need to be a certified investor to invest in certain deals? Does that depend on the account?
Another great question. Doesn't depend on the account type. So whether it's a traditional or Roth IRA or an old 401k, that's not going to be the kind of requirement. It's really, as you mentioned, whether it's a specific deal. There are certain deals. If you wanted to go buy a rental property tomorrow in your neighborhood or in your town, you could go do it with your IRA account. You don't have to be accredited or sophisticated or anything like that. If you wanted to lend money to a friend or a third party, you could do that as well. There are certain private placements, some real estate syndications, some private equity funds, where the requirements are that you have to be what's called an accredited investor before you can take part in that particular investment. To become an accredited investor, it's based on either your net worth or your income over the last few years. So there are certain deals that may require you to meet certain thresholds to be able to invest. So again, it really is going to depend. Now, the self-direct in general, again, no, there's no requirement. It's specific deals that the SEC has deemed you have to be an accredited investor to make that investment. And that's, to be honest, that's part of the executive order, I think, is to open up more of those types of investments to people who aren't accredited, but who do have 401ks.
Perfect. Thank you. And this question was from LinkedIn. So I was able to pop it here. And the question says, how do you believe the liquidity level would be reassessed to meet required minimum distribution requirements for 401k?
Good. Another great question. So for those unfamiliar with what a required minimum distribution is the IRS requires. So any money you put into an IRA over the years is growing tax deferred. You're not paying taxes as you invest and reinvest and sell investments. But at some point, the IRS does want tax revenue from any of your taxable IRAs or taxable 401ks. So they require you to take a minimum distribution starting at age 73. So you have to actually take about 4 or 5% out of your account every year and pay taxes on it. The concern would be is if your IRA was invested into fully illiquid investments. Let's say you took all of your IRA funds and you put everything into a private hedge fund and you had no cash. When it comes time to take your required distribution, you'd be in a little bit of a pickle. You'd either need to ask for a income from your private equity fund. You might have to sell off a portion of your private equity fund. So things can be a little tricky. That being said, most of our investors have IRAs with Advanta that are invested into those types of illiquid assets, and they have some IRA funds invested in a more typical Schwab or Fidelity brokerage account. You can satisfy your RMD by taking money out of one or both accounts. So if you have an RMD for the year, it's based on the total IRAs that you have, but you can satisfy that RMD from any one of the accounts that you have. So you just want to be careful if you're getting towards RMD age. You want to make sure you don't have everything locked up in something that's completely illiquid. If the investment's giving you income on a regular basis, and that income can certainly be used to satisfy the RMD.
Perfect. Thank you so much. Another question. Next question is from Oge. She says, how does moving money from the IRA account affect the account prior to being vested? Does it lose its ability to become vested at the appropriate time?
Great question. So IRAs are always they're already invested. If you have an IRA account, you're already 100% vested. That is your money. It's not going anywhere. There are 401ks that you have through usually current employers where you have to work there for a number of years potentially before you become fully vested. Even that, a lot of 401ks are immediately vested when you make contributions to it. So you have to check your plan. But moving money from one IRA to the other does not affect any type of vesting because there is no vesting period for IRA accounts as it is.
Okay. I have a question that an investor asked me recently, and I'd love to kind of pose it to you. And I think a lot of our audience will benefit from it. So after you invest in a multifamily investment deal and we sell, right? The deal's over and we sell and you make profit and the money goes back into the self-directed IRA. What happens at that point to the money sitting there? Let's say it's you invested 50, you got maybe 95,000 at the end of 5 years and it's sitting there. Do I need to move it back into like a Fidelity to be able to now maybe invest it in the stock market again? What is it doing as it's sitting in Advanta? Do I need to move it back to an IRA to be able to do it? What does that look like? What options do I have after I've received my profit and my equity from a deal?
Yeah, great question. So with Advanta IRA, we hold either alternative assets or just cash. So we're not a broker dealer. So the money is not going to be able to use our systems to just put any cash into Amazon stock or some type of Vanguard mutual fund. So this cash that sits with us doesn't earn anything, and it's FDIC protected, but it's not going to earn anything. So as you're receiving income back from the investment, like I said, you invested $50,000 and you're getting quarterly distributions. If you don't want that cash just sitting with us, you can at any time transfer that money right back to a Fidelity, right back to a Vanguard, again, tax-free. There's no limitation on moving the money back from the Advanta IRA account back to your Fidelity account. If at the end of the 5 years, the investment pays off and you have that 95,000 there, you have a choice. You could take the 95,000, roll it all into another real estate deal through Advanta. You could roll all of it back to a Fidelity or a Schwab IRA and just say, hey, I'm done investing in real estate, or any combination thereof. You could say, I'll take my $45,000 of profit, send it back to Fidelity, but let's take the 50,000 I started with and put it into another real estate deal. You have that flexibility to move money between IRA accounts, and there's no tax consequence, no penalties, as long as it goes directly from one custodian to the other.
Thank you. Someone is asking another question. So while they're asking, okay, perfect. The question has come up. I will, with OPERS, OPERS in Ohio, the retirement account is only vested after 5 years. Does moving money prior to the 5-year mark prevent vestment of the account at the 5-year mark?
I think that it would. That's, I'm assuming that's some type of public retirement system in Ohio. If you're currently employed there and it's been less than 5 years, the chances of you being able to move that money out of the plan is probably very slim anyway. So you may not be able to move it. But yeah, but in general, the general proposition, if you move money out of a retirement account before it's fully vested, you're probably only going to get a certain amount of the funds. And each plan typically has a vesting schedule. For instance, let's say at a 5-year period, maybe after year 1, you're 20% vested. After year 2, you're 40%, and so on until you reach that 5-year 100% vested mark. So each plan can be different. A lot of private 401ks immediately vest. So you put your money in as an employee, it's immediately vested. But that's something you have to check with, in this case, OPERS, to find out exactly what their vesting schedule is. And even if you're even able to move money prior to the 5-year times, again, a lot of times the 401ks, the 403bs, the public retirement systems can place limitations on your ability to move money while you're still employed there.
I think someone else was typing. I'll give them a second. We are close to the hour mark, but this is something that maybe I think you said, but I just wanted to make sure. Let's say I have $750,000 in an old 401k, and it's sitting there kind of not doing much, maybe in the stock market, and I decide to move. Do I have to move everything at once? Are there certain accounts where I have to move everything? Or can I make a decision to maybe use half and leave half where it is?
Yep, that's the beauty of the self-directed accounts, is that you can use as much or as little as you want. So in that situation, you have 750,000, and there's a $50,000 opportunity. Just move the 50,000 to us, because as I just said, if you have other cash just sitting with us, it's not going to do anything. So just move to us what you need to do. As the investment gains income, you can send some of the income back to your other accounts. There's no requirement that this is not an all or nothing strategy, I think, is the best way to answer the question. You can do some self-directed, real estate investments or alternative assets, and you can certainly have money invested in the stock market. It is, again, not an all or nothing strategy, not an either or. It's really up to you and what you're comfortable doing.
Perfect. I'm going to leave it. Last comment said, thank you, Scott, for coming. This is very informative. And Nkem, great job, as always, with organizing. I want to say thank you. If one more question comes in, I'll kind of linger a little bit, and Scott won't mind. But Scott, I want to say thank you. This was very educational. I mean it when I say, a lot of us here on this call, we have the resources, but we don't have the access. And so we don't even know about all these opportunities that are out there for us to take advantage of. So I'm so excited. We will be having conversations like this at Phoenix, so that we know what's accessible to us, so we know what's available that we can tap into. So I'm really grateful for your time. I have another question, and this is an awesome question. Does Advanta have deals investors can look through?
Great question. So getting back to the different case studies, we do not perform due diligence on investments, and we actually do not provide deals for investors to look through. That is up to you to find the investment, or talk to people in this group, or talk to Nkem, who may have deals you can look at. Our job is only to invest in things you tell us to. So we do not have deals that are kind of pre-approved or anything like that. There are some self-directed companies, I'll admit, that have that. I would worry about that, because I don't know that just because they're on their platform means they have evaluated the deal, because generally speaking, self-directed companies are not due diligence providers. So it is things that you would need to find on your own. I think being parts of groups like Nkem's is a great way to meet other people and get access to those types of deals, and then reach out to those individuals to help you evaluate them.
Perfect. And to kind of talk to piggyback off of that, we have active deals, and then we have more deals that are coming. So as always, our community, which are you guys on this call and more, you have access, and you have you get first right of refusal and knowledge of all that's going on. So as soon as we get new deals, as they come, you'll get access to it. And I want to say this real quickly as we wrap up, I think it's up to 30% of our investors invest with their self-directed IRA. And so this is something that I'm excited, because as more people know about it, they're excited to jump in on it. And we use Advanta as our custodian for our investors. So and like I said, if there's something up and coming, we will definitely make you aware of. You'll get first dibs, and then we'll take it from there. But I think there are no other questions. I think all the questions have come in. And the questions were wonderful. I think, thank you so much for the engagement. Thank you so much for kind of sticking through to the end. And I want to say thank you again, Scott, for this opportunity and to come and educate us. And I guarantee you there'll be a bunch of investors who will be in touch with you. So I'm very, very grateful. Once again, everyone.
Let's just say thank you. I want to thank you very much for having me on. So again, great questions, great engagement. Yeah, and I'm always happy to help educate people.
Perfect. Okay, everyone. On that note, have a wonderful evening.